Welcome back to the Michael Gaddis Show. I am your host, Michael Gaddis of www.michaelgaddis.com. I am also the CEO and NMLS licensed broker for Frontier Loan Group, Inc., or as we like to call it, FLG. FLG is licensed by the California Bureau of Real Estate, license number 01449152, NMLS ID number 345305. I am also licensed by the California Bureau of Real Estate as a real estate broker. My broker license is 014-33800, and my NMLS license ID is 280011. Today, I want to talk about reverse mortgages. And I know as I defined it last week, it's one of the most enigmatic loan products on the market today. When it comes to reverse mortgages, the thing I tell my clients is not to be afraid to ask questions. There is no such thing as a stupid question. I know that's a cliche, but it is true. There is no such thing as a stupid question. And I also tell them if you don't understand the answer that I give or whoever gives you, then you need to keep asking the same question again and again. You need to really understand what you're getting into. And when it comes down to it, reverse mortgages are not nearly as complicated as they seem. But I still think everyone should have a full understanding of everything that, of how it works from A to Z. So if that takes, 1 hour, great. If it takes 5 days, so be it. If it takes 2 months, so be it. You have to really understand what you're getting into. Do your research before you know whether it's the right solution for you. So what is a reverse mortgage? Well, a reverse mortgage, simply, it's a type of loan available to homeowners over the age of 62 that have either paid off their home or amassed a considerable amount of equity. Reverse mortgages are available through FHA's Home Equity Conversion Mortgage Program. That's in short for HECM, HECM, Home Equity Conversion Mortgage Program. HECM enables homeowners to either withdraw payments from the equity of their home or receive a single disbursement lump sum payment. So how does that work? Well, what it really is basically it's a negative amortization loan. So a normal mortgage works. A normal mortgage requires a homeowner to make monthly payments over a set of years. That's called an amortization period. So, a normal, like a 30-year fixed, is a 30-year amortization period. So that's the amount of time you have to pay back the principal balance. In a reverse mortgage, you receive a loan that does not have to be paid directly from you. Where does it get paid? It gets paid from your principal balance, basically. So instead of you having to come up with that money every single month, basically whatever payment you should have made gets added onto your principal. Now, that proposition scares a lot of people, but I'll tell you, for some of those homeowners out there who are on fixed incomes, and we're talking about some retirees who have Social Security, maybe a small pension, and they're surviving. They're surviving in a house that's almost paid off, but they're not living a quality of life. And as I say at FLG, your golden years should be golden. They really should. I mean, that's when you're supposed to be enjoying life the most. You don't have to work anymore. You're retired. And it is a shame what I see a lot. I mean, I see a lot of homeowners that come to me and tell me, Michael, I can afford to pay my bills, but I can't even afford to go out and have a nice dinner. I can't afford to drive and see my grandchildren because my budget is so tight. And a lot of these homeowners, they're too proud to tell their children that they're suffering so much. They don't want to tell them, that they're so financially strapped because it's either pride, they're the parents and, they don't want to burden anybody and burden their children with this. Or two, it's because, basically, just like I said, they don't want to have their children kind of supplement their living expenses. And so, that's where it comes down to. You got a homeowner who's, barely making ends meet that is living, but they're not living. And that's what a reverse mortgage can do for someone. It can change their way of life because let's say, for example, they're making a $1,500 a month housing payment, principal and interest payment. Well, with a reverse mortgage, they can eliminate that payment, and in some instances, they can get cash back either on a monthly or a lump sum type payment to help give them money to help survive. That's a huge swing. You go from making a $1,500 a month payment to making no payment and to get a monthly allowance every single month, all paid from the proceeds from your mortgage. That's why it's called a reverse mortgage. It pays you instead of you paying someone. So there are several different types of reverse mortgages. And, there's HECMs, and in some instances there's jumbos. But I think what we'll jump to is we'll talk a little bit more about what kind of options there are, because this is where a lot of the confusion comes in. It's like, well, what are my options? What do I do? Well, there's different types. They have what's called a 10-year reverse mortgage program. And this one is available to people who have adjustable interest rates reverse mortgages. Okay, now there is a difference there's two types. You can either get a fixed interest rate reverse mortgage or an adjustable interest rate reverse mortgage. So, but the plans available are different for each. In fact, the more flexibility is with the adjustable interest rate mortgages. And I don't think anyone should be like, I know there's a lot of fear with the word adjustable, but I don't think that should necessarily, preclude them from looking at the potential benefits of the adjustable interest rate. And there are a couple in here that I like a lot, which is the 10-year program, which is basically the borrower will receive equal monthly payments for as long as at least one borrower lives and continues to occupy in the property as a principal residence. So basically what that means is you no longer have to make your house payment, and you start getting a payment every single month for as long as you live in the property or are alive. Another type of program available to the adjustable interest rate programs is the term. Now, the borrower will receive equal monthly payments for a fixed period of months. Now, that's not one of my favorite options. I'm not because that option terminates. So after a fixed period of time, and then you won't receive that money anymore. So between the tenure and the term, I would lean more towards the tenure. I'd rather have the security of knowing I'm going to have a payment for as long as I live there, rather than knowing I'm going to have a payment for a fixed period of time. Now, it's obviously going to affect the amount of your monthly payment. It just depends, there's a lot of factors that determine, one, if you can qualify for these particular programs, but two, how much you would get. There's a myriad of factors that go in. And the purpose of this is just to kind of give you some general information. So the next is you can have a line of credit, and the borrower has the option to receive unscheduled payments or installments determined by the borrower until the line of credit is exhausted. So you can have basically a line of credit established. So if you are no longer making payments and you don't want to use any of the rest of your money, there's a certain amount of money that's set there, and you can tap into it whenever you need it. So let's say you have some, unforeseen medical bills or some expenses like that, then you can tap into that. And then they have what's called a modified tenure and a modified term, which is a combination of a line of credit and a monthly payment program, depending on whether it's a tenure or term. So it's kind of the best of both worlds. For the fixed rate interest rates, the borrower will receive a single disbursement lump sum plan. So that's the disadvantage of the fixed, is that you only get one single disbursement. You get all the money up front. And there's limits on that. So let's go to what are the qualifications for a reverse mortgage? Well, in order to qualify for a HECM reverse mortgage, the borrower must, 1, be 62 years of age or older, 2, own the property outright or have a very low loan to value, which means they have to have a lot of equity in their house, occupy the property as their primary residence. That's very important. So you cannot move out of the house and have your kids move in. It doesn't work like that. You have to be the person that's living in the house. You cannot be delinquent on any federal debt. And you must be able to continue making payments on ancillary property charges such as property taxes, insurance, HOA fees, Mello-Roos, etc. So basically what that means is a lot of times people in the past thought that the property tax insurance payment was going to be gone with the reverse mortgage, and that's not true. And that got a lot of people into some trouble. So it's really important to remember that you have to continue making your ancillary property charges, such as the property taxes, insurance, HOA. Now, the new rules for reverse mortgages require a financial assessment to determine that you have the ability to continue to make those. So that's a really nice little provision they put in there, because a lot of people were being put in this and then they weren't able to make their property tax, or they thought it was being made. So it's another way to kind of fix that. And lastly, people who want a reverse mortgage must complete a consumer education counseling by a HUD-approved HECM counselor. That's a third party that has to go through and kind of make sure you fully understand. And as I've told you in previous programs, I like that. I like the fact that there's a third party there, that there's someone that a borrower can go to and make sure that what they're being told is correct. I like that a lot. So that is the requirement. So those are your requirements for how to get a reverse mortgage. So, well, that does it for today. I want to thank you all for listening to the Michael Gaddis Show on AM1170 The Answer. I am here every Wednesday night at 8 p.m. discussing anything and everything related to real estate. If you want to contact me with questions or topics for the show, please feel free to email me at michael@michaelgaddis.com. Contact me at Twitter at MGJDRealty. Or call me at 888-242-2272. That's 888-242-2272. And you can visit my Facebook page at www.facebook.com/Michael Gaddis Realty Group, or visit my webpage at www.michaelgaddis.com. Again, you have been listening to the Michael Gaddis Show on AM 1170 The Answer. Good night, San Diego.